In this presentation, we will take a look at our second method for entering a loan balance and the related payments on that loan balance, this time breaking out the interest and principal portion of those payments within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in our guitar lessons and equipment file. We're going to go down to the reports on the left side, and within the reports we're this time going to go into the balance sheet, considering the fact that we had already made an adjustment in the prior presentation, taking this out of the uncategorized accounts and putting them into the balance sheet. So let's go into the balance sheet and review that, and then we'll go through the process this time. So we're going to go up top and we're going to say the dates will be 01/01/19 to 02/28/19, January through February and 2019. Run that report. And now let's just kind of recap what we had. You'll recall last time that we had a amount of a deposit of $50,000. And we said, hey, that was high. We have a question about that. Could that possibly be a loan? And the client said, yes, that's a loan and that's not a deposit from a customer. And therefore we took it out of the uncategorized income where we put it, because we were assuming all of the deposits were income from customers, and we flagged that one asking about it, and now they're saying no, that was a loan. So we now moved it to the loan balance on our books. So within our books then we see that on the balance sheet, and we've moved it to the balance sheet under the loan payable. So now we have that amount here. If we scroll into the loan payable or click on it, we've got the $50,000. There's the $50,000. Then we had another item that we had a question on related to it, and that's in February's bank statement. We said, hey, there is a payment that happened for this $944. There's a $944 payment that happened, and that came out of that was for Wells Fargo. What is that? And they say, well, that's a payment for a loan. And we're going to say, is that the payment on the $50,000 loan? They say yes. And then we say, okay, well, give us the loan documentation on that loan. And this time we're going to figure out how much of that $944 is interest versus principal. And we're going to try to track this loan in accordance with a proper amortization table. The best way to do that is to actually generate an amortization table like we did in the prior presentation, one which typically a loan won't provide us. After we do that, and we could do it ourselves, we can ask for the CPA firm to do that for us if we like. But once we have that table, then we can break out the interest versus the principal rather than relying on the tax preparer or so at the end of the year to do so. So we made the amortization schedule last time. So this is our amortization schedule. We're going to say, here's the $50,000 loan. Here's our payments. And we're going to break out the interest versus the principal each payment. And we could see, as we saw last time, the payment will always be the same. Typically, for most loans, they set that up so the payment will be the thing that stays the same. The interest versus the principal, however, will differ. And that's the cost of us having the payment remain the same. So we're going to have to then break out between the interest and the principal. So now we need to do that. What did we do in our simple method? We said, if we didn't know, we just put it all to the principal. We put that in the same account to the loan up top. And we were planning on telling the accountant, hey, that includes interest and principal, and you're going to need to break out the interest and principal for all the payments that are made by making the amortization table and determining how much of it was interest or principal, or whatever method you want to use to figure that out. So now we're going to say, hey, let's go back into this item and allocate it properly between interest and principal now that we have the amortization table. So we'll do that. We're going to go, okay, let's click on this $944, and the amount that cleared the bank is the same because it is what it is. It's $944. But we know now that there's interest and principal portion. It's this payment that happened. I'll highlight that, make it green. So we know that 208 of it is interest, and that's kind of like rent on it. It's just going to be decreasing. It's just going to be an expense. It's not going to be decreasing the principal. Only the 735 should be decreasing the principal. So then we got to say, all right, well, how would I put that into this payment? So we're going to have to say the amount, this bottom line number has to be the same, but the amount that's going to be decreasing the loan, according to this, is only 735, and this might be rounded to the pennies. So that's fine. Well, there might be some rounding difference. So this should be 735. And then we're going to have to record the other side to something like interest expense. So if we select the drop down, we're looking for interest. So here's an interest paid. So it's not actually paid. That's not really a proper name. We probably should just be calling it interest expense, but that's what QuickBooks is calling it. And so we could call it interest paid, but we don't. Anyways, we're going to have the interest expense. It's an expense type of account. That's what they gave us. So we're going to say that's going to be this amount. And the interest portion is 205. So we'll say that's going to be the 205. So this is 205. And then the sum of those two will add up to that 940, which it should be 944. And that's because I picked up the wrong number. It should be the 208, not the 205. So the 208, let's try that number. 208. And that gives us the 943. Now the reason that's a little bit different now is because there's rounding. And let me just show you in Excel if I was to add the pennies here. We'll add the pennies. You'll see it's a little bit different. So I'm gonna keep it rounded to keep our example just simple without the pennies. So let's change it to make the net number be the 944, which means I'm just gonna add $1 to one of these. Let's add it to the interest. We're gonna say this is 209, and that'll basically adjust for the rounding. That's because we're taking off the pennies here. So that's gonna be our adjustment, and now we've basically broken that out. So we've got the 735, the 208, and then the 944, the payment will remain the same. And let's see what that happens. We can check it to our amortization schedule as we go now. We can say save and close. We're going to say yes. And so the same amount came out of the checking account. No problem there. So if we go back up, we go back to our checking account. We didn't change anything up top. The checking account is what it is. It cleared the bank, and we're all good there. I'm going to close the hamburger up top. And that was the 944 that we had that cleared the bank on, here it is, 25. So that 944 didn't change. If we go back up and go back to our report, however, the amount that came out of the loan about, if we select this item, is now only this 735. And that remains, and note there's two loans in here, so it's a little bit complicated because we have two loans in one account, but the net of that particular loan is 50,000 now, minus, that's this 50,000, minus the 735, and that gives us the 49,265. If we go back to our balance here, 49,265. So that's what should tie out. We can tie it out, we could check it each time, and basically break these two out, and if they break out, the balance after that payment, after payment number 1, should be here. Second time we make a payment, it'll be slightly different, so we cannot just memorize this. QuickBooks will memorize the transaction and break out interest and principal next time between 208 and 735. That would be great if it was always the same, but it's not, because next time it's going to be 205 and 738. That's why we need the amortization schedule to really do this properly for most loans. So if we minimize that, then where's the other side? If I go back, then the other side's on the profit and loss report. So let's open up the profit and loss. I'm going to do that by duplicating this tab up top, right-clicking on it and duplicating. We're going to pull the tab from the left to the right. So we got the balance sheet on the left and the new report on the right. I'm going to select the hamburger, and we're going to go down here to the reports on the left, and we're going to select the profit and loss report, changing the dates up top from 01/01/19 to 02/28/19, January and February 2019. Run that report. Scrolling down, then we should see now interest paid, and there's our 209. So of course, if we select that, we're going to get our check. If we select that check, we'll see the detail that we input. Basically now, of course, 3 accounts being involved, same amount coming out of the checking account, but it being broken out between the loan payable, balance sheet account, interest paid, income statement amount. So if we close this back out and go back up top, back to our report, you'll see that now the net income is going down because the expense is going up by just the interest portion, not the full payment, and the loan amount is going down by just the principal portion. This is how we'd have to break that out in the most proper type of format For more accounting information and accounting courses, visit our website at accountinginstruction.info.